We syndicate deals. So we go out and we find deals that meet our criteria as operators in the apartment space, the self-storage space, the mobile home park space, the car wash space. And then we open those up to other investors that can passively participate alongside of us as general partners.
Hi, Adam Gower here, founder of gowercrowd.com and host of this podcast YouTube show, The Allocator, a new way to finance real estate, where I'm looking at the world of the capital allocator. My guest today is Chris Larsen, who is founder of Next Level Income. I met Chris on LinkedIn, as one does these days, and enjoyed reading his posts. And he actually invited me on his podcast. So I got to know him a little bit. He has a very interesting background he's going to be talking about. Comes from the medical device industry into real estate. He's got a long experience in real estate. And he talks about a capital allocator model very openly. The first thing that he says is, I am an open book. And sure enough, he was very gracious with the discussion that we had, and you're going to learn a lot about both Chris and also about how the industry works. If you'd like to learn more about Chris, go to gowercrowd.com, find the podcast page over there, and I will include links to his website and also to his LinkedIn page. So you'll be able to access that there. And while you're there, be sure to subscribe to my newsletter. It comes out every week. And I am covering, it's actually a smorgasbord of all kinds of tactics, tips, and insights into both capital formation for real estate investors, but also how to invest prudently based on my extremely long career in this industry, longer than I generally like to admit, all there at gowercrowd.com. But now let's turn it over to Chris Larsen, founder of Next Level Income, coming right up. Chris, it's good to see you again. Another person I met on LinkedIn. I do love LinkedIn. And thank you also for having had me on your podcast. So it's nice to be able to reciprocate. So let's start at the very top. As you know, I'm interested in the capital allocator model and what you do. But why don't you tell me, what do you do over that Next Level Income? How do you make a living?
Yeah, so Next Level Income, Adam, was founded actually as a nonprofit, which some people are going to roll their eyes now. But if you go to our website, nextlevelincome.com, our mission is to help people achieve financial independence. Because I really believe that with financial independence, we all have better capability to live and be our best selves. That could be helping out your community when there's a disaster like we had here with Hurricane Helene. It could be spending time, focusing on your family, like not missing your son's basketball and lacrosse games like I do. Or it could be focusing on growing your business so you can do more of what you do out there in the world. But how do we make money with that? We also syndicate commercial properties. We've done about 2 billion of acquisitions in the last 8 years, Adam.
Right. So let me just pause you
Yeah.
right there. What do you
Sure.
mean you've done 2 billion of acquisitions? Just explain.
Yeah.
I want you to open, you said you're an open book. So open the book. Tell me
Absolutely. Yep.
exactly what you mean by that.
Yes. So we syndicate deals. So we go out and we find deals that meet our criteria as operators in the apartment space, the self-storage space, the mobile home park space, the car wash space. And then we open those up to other investors that can passively participate alongside of us as general partners.
Okay, but I remember you telling me that I forget which it was. I think it was the self-storage you own yourself, but multifamily you work with sponsors and you funnel capital to them as a capital allocator. That's the model, isn't it? That's the one that I'm interested in.
Yes, so it's evolved a little bit over time. So I started off as a two-man show with my partner and I, and we were buying and operating those deals. But as you grow, like many people listen here, understand that you can't do it all yourself. So yeah, we have more of a fund structure now where we're bringing in capital and then we allocate those to deals that make sense.
Right. So tell me about those. So the apartment, so you've got it says 1.5 billion on your website. You just said 2 billion. But please explain to me exactly what those numbers mean. You've invested
Yeah.
actually how much in those deals?
Yeah, about 120 million in those deals.
Okay. Over
Yeah.
what period of time?
Yeah, we syndicated our first deal in 2016. And those first we did five acquisitions between 2016 and 2019, Adam, that were on the smaller side. They were in the Atlanta market. So we acquired 600 and about 670 doors down there in the Atlanta market.
And was that
And
as
then
a principal, Chris, or was that again with sponsor partners?
yeah, that was directly as a principal, as a general
Okay.
partner in those deals. That's right.
All right.
Yeah, and then
Mm.
And then at that point forward, we started to grow and work on partnering with operating groups, and we would bring capital to those deals as a partner in those deals.
Right. So, and then how do you structure those deals? Explain that to me. How does that
Yeah,
let me try and preemptively ask. You tell me if I've got it right.
yeah,
You negotiate preferential terms with the sponsor and then either harvest the delta or pass it on to your investors. Just in that context, how
yeah.
do you do it? Yeah.
Yeah, so that's what we do today. I think that's the best way to do it because we can say, oh, there was this deal and that deal, and but what we do today in general, Adam, is yeah, we have a sponsor. I had three deals come across my desk yesterday, for instance. So as an investor, if you go in and say, hey, I like this deal, I want to invest $50,000, you may get, say, a 6 or 7% preferred return and maybe 70% of the profit.
Hmm.
What we like to do is go in and say, hey, we're going to invest $1 million, $2 million in this project as maybe an anchor investor or a larger investor. And in that case, we may get 8, 9, 10% preferred return and say a 90% split of the profit. So what does that mean to our investors? That means if they're in that fund, they get higher overall returns typically. So, there's some margin there. We have an asset management fee for the fund. But investors, they typically get better returns. They get also more diversity. So for your dollar coming in alongside us, you typically can get higher returns and more diversification than if you were directly in one of those deals.
Okay, so do you pass? So you gave an example of a 6% for a $50,000
Yeah.
investment, six
Yeah.
and a seven,
Call it
70 over a
call it
six.
7%, 70, for
Okay,
instance. Yeah.
70 over a seven,
Yeah.
and you might negotiate 90 over a 10.
Sure. Yeah.
What proportion of that delta do you keep, and what proportion do you pass on to your investors?
Yeah, great question. It varies because, it would depend on deal by deal basis and how that works. But I think a good example would be to say, hey, let's say we go from a 7 to a 9% preferred return and a 70 to a 90% split. So we would typically split that with investors. So they're going to get maybe half that upside. And then we have a little bit of margin above that for ourselves.
You have a little bit of margin.
Yeah.
What's
So if you had, yeah. So in that case, right, as an investor, you'd be 70%, 7% preferred return. If you came alongside us, you might get 8% and 80% of that as an investor alongside of us. And then there's another percent and 10% above that that would be left as the sponsor for that.
And that's the fee. That's basically how you make your living. You
That's how we would make our living.
harvest that. Okay. And
That's
what
right.
is your percent? What is the asset management fee? How does that work? How much is that?
Yeah, so it's usually about a percent. And that would be, and that our operating costs for the fund and any back office fees and those sorts of things come out of that. So that kind of keeps the lights on, so to speak.
Yes, right. So 1% of the total amount of money that you've raised.
That's correct. Yeah, that would be active in the fund. Correct. Yeah.
Active. Okay. And so of the 2 billion of assets that you've got, just let's focus on the ones that you've done as a capital allocator.
Sure.
Those are all with other sponsors, kind of the primary sponsor. You bring the capital in
That's
for
correct.
them. Yeah.
That's correct. Yeah.
Okay. Right. And so how do you choose a sponsor? How do you what are your criteria for finding a sponsor?
Yeah, so I've only worked with individuals and groups that I have a long-term relationship with. So we really only have three main partners that we work with as operating partners. I've known all of them since 2019. So we're
Ah,
talking about 6 year relationships.
hmm.
So typically what I do in Adam, I go in, I say, okay, if you brought me a deal, I'd say, okay, we've had a relationship, I've known you for a while. I've typically looked at your deals for several years. Like take the deal we just did in Houston at the end of 2024. I've
So,
known,
sorry, what did you say?
yeah,
Houston? I missed
Houston,
that.
Texas,
Yeah.
correct? Yeah, Houston, Texas. So I've known this group for over 5 years.
Can you tell me who they are?
Yeah, Lone Star Capital
Okay,
is
Lone
the group.
Star.
Yep. Yeah. So Rob Beardsley has been a long-term friend of mine. I've I've looked at deals with him for years. We've been co-sponsors of deals in the past, and I followed him and his group and their specific strategy for many years. So I've spent time with him, with his team. I've been on site at his previous deals. I've spent days with his management company. They have a vertically integrated management team. And so that's the first step. So like I said, I probably got 10 deals this week that have come across my desk. And most of them are just no's, but I'm always looking for interesting opportunities that may be future potential.
And who are the other? You said you invest with three sponsors. So who are the other
Yeah.
two?
Yeah, so we have our mobile home park team. That's Cultivate is the name of that group. So it's my
Hmm.
partner Bryce, and I've actually been a GP in those. So I've worked alongside Bryce on putting money up for like hard money, earnest money, signing on loans, asset management with them, and so I've known them for 6 years as well. Bryce is actually right down the road here, about 20 minutes south of me in Asheville, North Carolina.
And then the third one
Yeah,
is
third
that
one is passiveinvesting.com. So my partner's over there, same thing. We've known each other for about 6 years and
that's Dan
done
Halford's shop, right?
Hanford. Yep, that's right. Yep.
Right. Okay. And what do
Yep.
they do? They do multifamily, right?
They do multifamily, self-storage, and car washes, as
Okay.
well as they have a private lending arm as well.
So that 120 million that you've raised from investors and placed
Yep.
with these three sponsors,
Mhm.
uh, from how is that spread out over the last, you said you started in 2019, and I do
Yeah.
remember you saying how much you raised last year. So, but how has that been spread out over the last 5 years or 4 years,
Yeah,
I guess?
over the last 5 years. So about half of that is in the last 3 years, and the other half is in the previous 3 years. So, or I'm sorry, more. You're going back say 3 years, 22. I guess it's been 8 years, 8 years total. So, yeah, we had, starting off the first deal I ever did, I raised about $850,000. So, now we've placed anywhere from 1 million to almost 10 million in some of those deals.
How are they doing?
Say that again.
How are your deals doing?
Yeah, so I'll tell you, we have deals that have done tremendously well. We have deals that are performing very well right now. We've got a couple deals right now with floating rate debt that we've had to suspend distributions. So we're reserving funds for interest rate cap purchases, those sorts of things. Operationally, they're all performing well, but cash flow has been an issue on some of those deals with some of that short-term debt, as I'm sure people that are in that space understand.
And any capital calls?
We have had a couple capital calls. Yeah, we're dealing with that right now, as a matter of fact.
And do you always act as an LP, Chris? So your role is you always so the way you do it is you set up an entity, presumably, and then your investors invest in that entity, and then that entity invests as an LP with the sponsor. Is that how it works?
That's not always how I've done it. I've been a GP on most of those deals. So I've had an active role in most of those deals that I've done. We actually have a unique structure for our mobile home park fund currently, which is a co-GP structure. So investors actually invest in our fund. That fund invests as an LP, but our GP capital and our LP capital and profits flow into that fund, if that makes sense. So investors are actually participating as an LP and they get a portion of the GP upside through that fund.
Okay. But so you said that you act as a GP. So what does that mean exactly? So, like for
Yeah,
example, with passive income or with Lone Star, how many
passive
GPs might
investing.
they have on a single deal? How
So,
many
all right, so
co-GPs? Yeah.
I would have to look on a deal by deal basis. So like four, five
Okay.
would be probably a reasonable amount. Yeah.
Who have essentially the same role as you have.
It, I'd have to defer to them to see who has specific roles. So I know what my specific role is,
Mm.
and sometimes I'm the one on site doing the inspections and doing those sorts of things. Asset, initial underwriting, uh, capital allocation strategies, investor management strategies, as well as overall, like we have quarterly asset management calls as well.
Okay. And
Those are typically things that I participate
all
in.
right, but the primary role is to bring capital, right? I mean, that you wouldn't be there if you weren't bringing capital.
Um, some I have brought deals, so I think it depends on a deal by deal basis. Yeah,
And in each deal, do you co-invest?
always. Yep, I've always invested in every deal I've
And
done.
what does that look like, Chris, typically?
Is a
So,
is
so
a
give me an example of an actual deal, like a case study, like a
Yeah, yeah,
recent
yeah.
one that comes to mind where you raised, like
Yeah,
how big was the acquisition? What was the
yeah,
equity, total equity?
yeah.
How much did you raise and how much did you invest
Yeah, so let's
alongside your partner?
let's take like one of our mobile home park acquisitions last year, like a $7 million acquisition. Okay, we're typically bringing 25 to 50% of the capital for one of those.
Okay.
So I may be putting up a couple $100,000 of earnest money in that deal, potentially signing on the loan with my own capital. Then we will typically a deal that size. $7 million, we may invest, say, $2 million in that deal of total equity. So, I'll put up, say, 10% of that 2 million of my own money in a deal like that, as well as potentially personally signing as a guarantee on a loan like that.
Right. But Hanford's deals, for example, are much bigger, aren't they? I mean, they're into the
Yeah.
high tens. So what does a deal like that look like?
Yeah. So if $100 million acquisition,
Hmm.
where we're investing, say, $5 million in a deal like that, I'll still probably invest somewhere around six figures in a deal like that, where I
So,
maybe,
so you might say, so that's okay. But in terms of the amount of equity that you bring to a $100 million
yeah,
deal, so you're looking at
yeah.
35, 40 million of equity. How much will next
Across,
level bring to something like that?
last I checked, the average per deal, we were bringing about 20% per deal.
So that would be 8 million into a $40 million raise. Does that sound about right?
If it was a 40 million, yeah, that'd be about right. Yeah.
And you would invest how much as a co-invest in
Yeah,
that kind?
50 to $250,000
Okay, all right.
approximately. Yeah.
And no other fees, just the asset management fee and the delta. You don't get paid by the sponsor or in any way.
So it depends on if we're talking about two different things, right? So we were talking about a kind of the structure today with a fund.
Mm.
So if I was just a direct GP in the deal, I'm typically going to get a piece of any of the fees that are associated with that deal. So a piece of the acquisition fee if there is one, a
Ah,
piece of the asset management fee that's ongoing, a piece of the disposition fee, and then any GP upside that is in that.
okay. And then also the delta that you get in
That GP upside, I guess, is what I was referring to as the delta. Yeah.
the GP. Okay. And
Yeah.
so so sponsors actually pay you a percentage of whatever fees they're harvesting.
Correct. So it'd be typically a similar percentage across the board. That's right. Yeah.
Interesting. Okay.
Yeah.
And then how is that percentage determined?
How is the percentage determined? We
Yeah.
determine on the front end based upon activities performed.
And Scott, I know that we're talking
Yeah.
compliance, and that's really what
Yeah.
I'm getting at. So, how do
Sure.
you get
Yeah,
to?
I
Yeah.
think this is very important because, if you say, "Hey, I'm going to
Mm.
bring," and I've seen this, right? You talk to groups. I've had sponsors reach out to me. They're like, "Hey, bring $1 million and we'll give you, a percentage based upon that." And really, that's how an RIA operates, right? So, and that's not how a GP operates. You can do that through a fund, a fund
Mm.
structure, and that could
Hang
be
on, so you
done.
could, what can you do through a fund structure? So let's go back to $100 million deal, $40 million raise, 8 million of
Okay.
equity, let's say
Yep.
that you bring.
Yep.
In the example
Yeah.
you're giving that you've
Sure.
seen, that
Yes.
would be somebody would say, okay, if you bring 20%,
Hmm.
we'll give you 20% of that. That basically they tie the compensation to the amount raised. That's what you see
As a GP,
as a GP. Or in the
that's
fund, you said actually in the fund, that's how it works.
yeah.
The
So in the
fund
fund, I
structure.
may be able to say, hey, I'm going to take 1% or 2% of whatever capital is in the fund, right? And that's easy math to do through a fund. From a GP structure, it's going to be a lot more complicated because you have to split it out based upon your duties coming in versus capital raised. If that makes sense.
Okay. And so what is the fund? Because this is something that I don't think people really understand.
Yeah.
This is through, and you mentioned
Yeah.
Avesta. I pronounce it Avesta, but anyway, the same thing. This was my first podcast guest on this season.
Yeah.
But so what is it? Explain what a fund is as you understand it, because the terms have changed in the last.
Yes. So, all right, let's back up a little bit. So if we say, "Hey, we're going to go into business together and it's just going to be me and you, Adam, and we're GPs in that deal." We may split things 50-50. And we'll say, "Hey, you're going to find the deal, you're going to deal with the broker and, you're going to handle maybe some day-to-day operations and then I may handle going out, getting the loan, bringing in the capital, investor relations, um, overseeing ongoing management and those sorts of things, right? So, okay, so we decide to split everything 50-50. If we start talking about strictly bringing capital, you have to consider, are you truly acting as a GP and are you actually actively engaged in day-to-day operations and dealing with that? On the mobile home park side, I'm I'm I was just on with the team here this morning. Um, so I'm actively a GP in all those deals and all those operations, right? That's going to be a lot different than if I say, hey, I'm just going to write you $1 million or $2 million check out of our fund and doing that. So it's typically not, it should not, compensation should not be tied directly to the capital brought to a deal. It should be negotiated ahead of time based upon the activities that you're performing.
Right. So in those
Yeah.
cases, and again, what have you seen? Because I know you're very,
Yeah. I've seen, yeah, and it,
you're conscious of the and
yeah.
aware. You come from a very sophisticated background.
Yeah.
So in terms of compliance,
Yeah.
then so what have you seen in terms of so somebody says, all right, all I'm going to do is bring you capital,
Hmm.
and I'm going to bring you
You shouldn't be a GP then. Yeah. You shouldn't be a GP in that case. Yeah.
so I'm going to bring you capital. I'll
Yep.
bring you $1 million. It's a $10 million raise.
Yep.
Uh, how have you seen people negotiating their splits on that?
Yeah. So typically what you see in that case is you should send up a fund and bring your capital through that fund, and then you can set up your management fees and do that through that. So you could do in that case, you could do an acquisition fee on the front end. You could say, hey, we're gonna have a due diligence fee where we go out and we're gonna charge say 2% and manage that. Our fund is a lot simpler in that we just have a flat fee. So we pay ourselves everything out of that flat fee.
Hmm.
And that could be, I would say anywhere from 1% to 2% annualized is the range that I've seen. So for a $10 million raise, that would be say anywhere from 100 to $200,000 annualized.
Um, right, but I was it's I'm sorry so in that case it's the
Yeah.
investor that's paying. The investors are
Well, the
paying that.
investor's always paying, right? Like it,
But if you set up a fund,
yeah,
it's the fund, and then investors come into the fund.
right.
It's the fund that is charging those fees, so it's
That's
coming
correct.
out of investor capital. They are paying those fees.
That's correct. Yep.
Right. But then you also get some share of, so how does the GP, the co-GP structure work? Where somebody comes in and says, I'm going to bring $1 million and it's a $10 million raise. And in return for that, can I get 10% of GP economics? How do those types of deals, not the fund,
Right.
direct investment, how have you seen those work?
So you're saying if I just said, "Hey, I'm just going to bring you capital
Yeah.
as a GP?"
Well, I'm asking, is that, how have
Yeah,
you seen that work where people don't actually
yeah.
have any real role other than bringing capital?
I would say that's you shouldn't do that.
But you can do it through a fund. Is that what you were saying?
Correct. Yeah. So you either need to be an active GP where you're doing more than just raising capital,
Mm.
or you should do it through a fund. And I think there's a clear delineation there and that's how I would do it. I would say, hey, if you're just bringing capital, the best way to do that is to set up an LLC or a fund. Where I've had investors where they'll say, hey, I've got um, we'll say, hey, we'll give you better economics if you bring, say, 500,000 or $1 million, but they've got to set up their own LLC with their own, say, three, four, or five investors and do that sort of thing.
Right. So in that
Yeah,
case, just to be clear, what I'm asking
yeah,
for, then we'll stop
yeah,
this. I just want to understand. So I've
yeah,
got a fund and I go to a
yep,
sponsor with my fund and I
yep,
say, I'm going to bring you 10%.
yep.
I want 10% of the GP economics.
That's probably reasonable. Yeah, that's probably reasonable. Um, but again, that you need to set that up through your fund. So you can negotiate a higher split like we were talking about. Maybe you get a higher preferred return, you get a higher back end split, and then you have to figure out on your side with your fund how you're going to have it make sense to investors. Because my perspective is if investors are coming in through my fund, they need to get some sort of value for that fund or going through that deal.
Right. So capital allocators, there are
Yeah.
a lot of them and a lot more
Yeah.
coming in to the market every single day. Chris,
Yeah.
how do you differentiate yourself
Yes.
from all this flood of newcomers to the industry?
Yeah, so I think again, it's like there's not some magic bucket of deals that are going to outperform other deals. Like deals that are out there are competed for by others. So if you have a source of like we do on the mobile home park side, right, of off-market deals, or on the car wash side of off-market deals where we have relationships with the top 100 owners out there in the market, that's a differentiating factor.
Mm.
If you have more total capital to allocate, so if I'm writing a check through a fund, and I can say to you, Adam, as an investor in our fund, you're going to get better economics coming in through that. So you have access to the deals, but also you get better economics as an investor, better diversification.
Mm.
That is a differentiator.
Okay, so however, that is
Yeah.
the same that is the same as every capital allocator. Every capital allocator goes out and says they negotiate, we got better terms and you can get in and we're either gonna, we'll split it with you or the minimum's 1 million into this deal, but you only need to invest 50,000 and we're
Yeah.
aggregating it, et cetera, et cetera. So that doesn't differentiate them. That's not a differentiator. What I was getting at
Okay.
was, and I know this is difficult, Chris, seriously, because I see it all the time in this industry.
Sure.
Look,
Oh
I've
yeah,
been
yeah.
raising money all my
Yeah.
entire working
It's
career, basically.
it is there. Yeah, it is hard to differentiate yourself in this
It's
space. I mean,
not, though, actually. It isn't. That's the thing. All right. So here's your differentiator. This is what I thought you were going to say. Actually, I knew you weren't because I follow you on LinkedIn and I see your posts. And I've been on your website and I know that you don't tap into this, but I do have some follow-up questions for this. You come from an extraordinary background,
thank
right?
you.
You come from a medical device background. That
Yeah,
is a highly technical,
it is. Yeah.
extremely sophisticated, complicated asset to, product to be in.
Right.
That to me is highly differentiating your experiences in that world and what you
Yeah.
learned about life. And I'm not talking about, passive income and freedom and all that kind of stuff.
Right.
I'm talking about challenges and how you solve problems and how
Yeah.
people think.
Risk mitigation. Yeah.
Risk mitigation,
Absolutely.
exactly. Risk
Yeah.
mitigation. Again,
What do you do? What do you do when the patient's well-being or potential life is on the line? Right.
and
So,
what is and I
yeah.
am absolutely look, I'm absolutely certain it's wrong. I know
Yeah.
that you connect dots from that experience to real estate and what, with the greatest respect, and I'm not just saying it to you
Yeah.
because I see it all the time. It's funny because that does not come across at all in the way that you communicate. You're right, in on LinkedIn in the posts or on your
Yeah.
website. I mean, it's there. You can see it. But that to me is what makes the world of difference. I mean, if you
That's a
think
great
about
point.
it,
Yeah.
right? Seriously.
Yeah.
Otherwise, everybody starts sounding the same. I mean, I see it all the time. It's like everybody went to the same conference somewhere with 5,000 other people. They all came
Right.
away with templates. And so everybody sounds templated and copy and pasted. And in a world of AI, you have to differentiate yourself. Otherwise, you just become part of the machine. It's how you separate yourself. So let me ask you this.
All right.
How did you transition from medical devices and financial freedom, all that kind of thing, into another really technical, tough, high risk environment, right? People's lives aren't
Oh
on
yeah,
the
yeah,
line,
absolutely.
but their financial lives are on the line.
That's
So
right. They're
how did
trading.
you
Yeah,
learn?
because
What was your learning process to
yeah,
learn real estate? It's coming from a guy who's been doing
yeah,
it for 40 years. How did you do
yeah,
it when you migrated from
yeah.
medical devices into real estate?
Well, so you didn't read my book.
I didn't.
We're gonna,
No.
yeah. So we're gonna go
I
back.
want the
We go,
Cliff's notes
yeah, yeah,
right
yeah,
now.
yeah. So if you read my book, and if you want to get a copy of my book, you can go to nextlevelincome.com and check it out.
Thanks, Chris.
So I bought my first property when I was 21. So I've been doing this 25 years. So I learned firsthand what to do as an investor. And I invested, managed my own portfolio for 15 years. I went into the medical device space, and this is what a lot of people they're like, "Oh, how did you transition? What did you do?" I was actually, and I got this from mostly from the people in the med device side. They'd see me as a high performer in that space, and they'd say, "Oh, you're transitioning into this." The truth is, I was always an investor first. And I went into the medical device space to generate capital so that I could continue to be an investor.
Aha.
So yes, I learned a lot of things with respect to risk mitigation. My undergrad here is in biomechanical engineering. My MBA is in portfolio management. So how do you manage? How do you allocate capital? How do you look at deals? Everything from real estate to businesses. I like real estate, commercial real estate, because it has aspects of both real estate as well as business. But I think what you're hitting on and what's across both spectrums is how do you assess the upside risk and the downside risk? And how do you mitigate the downside risk and still maintain upside risk that is disproportionate to to the risk that you're taking, right? And that's what you have to do in a surgery. That's what surgeons look at every time they say, "Hey, we want to get the best possible outcome, but what's the Hippocratic Oath say? Do no harm." That's the first thing. So the way I look at it is, how do we preserve investor capital? That's the first thing. It's what Warren Buffett says, right? Like, you know, so if you don't lose money, don't lose money. Don't lose money. That's the first thing you want to look at. Make sure the patient comes out of that surgery, they're alive, they have the best possible outcome, and hopefully they get the the absolute best. But you're not going. Here's a perfect example. Um, my stepfather, take him into the cardiologist just a few weeks ago. Okay, he has some heart issues, and the surgeon says, "Listen, you're 71 years old. Your stepson's sitting here. He's 46 years old. If it was him, with his active lifestyle, he's out riding, we would probably do heart surgery. We would do that. But you're fairly sedentary. You're happy. You don't have any symptoms. We're not going to do heart surgery. We're going to manage this with medication and do that. So that's a great example of, hey, yeah, we can go do surgery and tune your heart up, but there's a massive risk. Like, you might not come out of that surgery and do that. So from a deal perspective, it's like, how do you look at a deal and say, you know what, we can make a lot more money in this, or we can exit today with a profit, get out, get the risk off the table, and take our money and move on to the next deal.
This is exactly what I'm talking about. You actually went back a question
Yeah,
and started to tie your experience in medical devices back to real estate,
yeah,
which is just
yeah.
fantastic. I mean, that's
So moving forward through that, so then I say, okay, like you said, Adam, when I work with investors, I actually see money as life, because if you and I've had this discussion with my two boys, 13 and soon to be 15.
mm,
Said, guys, like, you, to make money, you have to trade your time. What is your time? It's your life that you're living. So I see every dollar that an investor has that invests with us as a portion of their life. So if I'm losing their money, they're giving up their time, right? So you're taking, if you lose investors' money, you're taking a portion of their life and their time away, their opportunities to do that. So I really that's how I see things, um, through that lens.
So what are the typical? So let's start wrapping up. I've got some rapid fire questions to ask you
Yeah,
in a second. But what are the typical investors? What do they? What's their avatar? Not avatar, but what
yeah,
do they look?
sure.
I mean, 120 million is a lot of money. So how many investors, and what would you say is if you could generalize their demographic? What does that look like?
Yeah, so we have about 300 active investors, and our typical investor, Adam, is their first generation wealth. So, we got surgeons, we got business owners, we got executives that are out there, typically 2 to 10 million in net worth. They're usually making anywhere from $200,000 a year to, we're talking median, like two to say 800,000, somewhere in that high
Hmm.
six-figure income. And, my goal is to give them the opportunities that family offices have and get in there and truly get into assets that their typical advisor, Edward Jones, et cetera.
Well, they can't
They
provide
can't
access, right?
exactly. They
And
can't.
so, but
Yeah,
what kind of so are they? What kinds of careers, Chris? What kind of
yeah,
like what does that look? When I say demographics, I mean what do
yeah.
they do
About
for a living?
25% are physicians.
Hmm.
I'd say kind of that the 50% are high income professionals, and then probably another 25% are business owners that are successful business owners that are out there.
Okay,
Yeah.
fascinating. Thank you for undergoing the gauntlet of my
Hey,
questions on
I
this show.
said I was an open book, man,
You
and
did say you're an
yeah,
open book.
yeah,
Indeed, you did. Yes. So, all right. So let's wrap up with some final questions. We're coming to the end here.
yeah,
First of all, you've got some deals that are struggling. You've raised
yeah.
120 million. You're dealing with 300 investors. Doubtless, some of them are not so happy. What
Sure.
is the hardest lesson you've learned in real estate so far?
Yeah, the hardest lesson is how do you differentiate the crazy from the logical? And you can have the most challenging aspect. And again, if you're working with a surgeon, right, you're working with somebody that is probably more intelligent than me. They're highly skilled. They understand that. But I've also seen more than the average surgeon that I worked with. And what I mean is I was doing, say, 20 surgeries a week, right? I was in 20 surgeries a week. So if you're a physician and you may come to me and say, "Hey, Chris, I have this case, and I see this once every year or 2 years." You may say to me, "Hey, what are you going to do in this situation?" Right? So now I'm in this position where I have to take the knowledge that I have, translate it to you, even though I'm not technically the expert in the procedure in that you're doing. However, I have more knowledge with respect to that. So you have to communicate that in a very refined way so that you can give that surgeon the tools to operate. But if something doesn't go well, so let's say
Let's
a
get
piece
back
of
to real estate. Hardest
it, no,
lesson
no, no,
for
this
real.
is it
Yeah.
never left. So if a
Okay.
piece of equipment breaks, right? Surgeon's like, hey, like this is a problem. It's a failure,
Mm.
right?
Mm.
So just like we were talking about, the debt markets broke a couple of years ago, right? So now you don't have the same tools available. What do? You've got to tell the surgeon, hey, this is a problem. I don't have a perfect solution to this because we don't have a replacement for that, but we're going to do this instead, right? So you have plan A, plan B, plan C. I always say you have your shit hits the fan plan, right? Like what do you do if everything goes wrong, but you still need to get out there out of that surgery with the best possible outcome? It's the same thing when you deal with these investors. The problem is that surgeon might not like that answer, even though that is the answer. So what I've learned is you just have to, one, communicate as quickly and concisely as possible and not be emotional about it. And it's tough because investors are dealing with emotions and you have to be considerate of that. You have an investor that says, hey, I'm going through a divorce. A hurricane just blew my roof off. I need this money. I need more money, right? you have to be sensitive to that situation, just like you have to be sensitive to that surgeon who is responsible for dealing with that patient on the other side and understanding that you have to have empathy for what they're going through. So you have to, again, it's important to be knowledgeable, communicate, illustrate the options that are out there, and try to stay unemotional about it. But the hardest thing is, you got to walk away from that. Like I still wake up in the middle of the night thinking about procedures that didn't go well when I was in the medical device field. And those deals, it keeps me up at night. It's like, well, what are we going to do in this situation? But communicate to investors and let them know in a very unemotional way what's going to happen.
Yeah, it's tough, right? It's very tough.
It
Uh,
is, yeah. There's no easy way to deal with it, but you just have to deal with it.
okay, that's interesting. Okay, let me move on to the next final kind of
Yeah,
round. It's the final round of questions.
yeah.
So there's something else I'd like to ask you, but we're running out of time. So, what have you found to be the most effective way of building your investor network, Chris?
Yeah. Referrals are great. So, if things are going well, referrals are terrific. My book funnel has worked well. So,
Hmm.
I give a lot of people are like, you just give your book away. So I've been giving my book away since the beginning. You can buy it on Amazon.com if you want. But I think when people understand the story that you have and connect on a personal level, I think that's very important. And I think we forget that in today's, you mentioned AI. AI can do so many things. It can even pass the Turing test now, right? But people in this enhanced digital world and increasing digital world that we have, I think they still want a personal connection. And if you go back to sales and you go into what we're doing, I think it's important. If you're out there raising capital, if you're working with investors, or you're even in sales in general, find out the why behind the why. Like, why are investors investing? What is truly important to them? I just finished lunch with an investor. He has a son with special needs. He lives in kind of like a halfway house, if you will. And what's important to him is generating financial stability for his son. So it's important to know that, and that's important
So
to
the
him.
book funnel has been the most effective way, but how do you get that out? Is that strictly on your website, or have you
It's on our
advertised it?
website.
Or
Do a lot of podcasts. I've probably done 600 podcasts
oh my goodness,
in my
really?
time. Yeah, between the ones I typically try to be on a podcast like I am here today,
Mm.
and produce a podcast once a week. So I'm trying to do about 100 podcasts a year.
Oh my goodness. Okay.
Yeah.
Podcasts. Very interesting. Right. And capital allocator industry. A lot of
Yeah.
people coming into it. What does it
Yes.
take to be a successful capital allocator today?
Yeah, so again, be aware of the rules, the guidelines that are out there. Make sure that you are talking to an attorney and you have your structure set up properly, because you don't want to structure things improperly from on the front end and then go down that pathway. So I think one, make sure your structure is right on the front end. Two, if somebody says, "Hey, it's easy to start a fund and it's easy to raise $1 million," I think you've got to look at the capacity. If you can raise 10 million, $100 million, this is a business that your customers are going to be with you until that last deal is sold. So you need to have the right mindset. You can't go into it and think like, oh, I'm just going to raise $100 and walk out the door, and that's all I'm going to do. You are starting a business that is going to have clients or investors for years and years. So you have to have a long-term mindset with that. And you have to have a team built around you to support those investors and that ability. And then you have to have like I said earlier, you have to be willing to communicate. I just spoke to an investor. He's in a couple sideways deals with another operator, and he reached out to this guy and he said to him, "I don't have time to deal with investors that are worried about the state of the market," something to that effect. He basically told him to go F himself. And do you think he's going to reinvest with that guy?
So
No.
that actually brings me on
Yeah.
to the next question,
Yeah.
which is relevant as well. So if you could go back in time to when before you placed the money with passive, what was it? Passive income. I forget Hanford's
Passive
short term.
investing.
Passive
Yeah.
investing,
Yeah.
or with Star
Lone Star.
Lone Star.
Yeah.
If you could go back to the time before you did that, what
Yes.
advice would you give yourself?
Yeah, I would say, and I was mentioning this earlier, you have to be very careful about the partners that you choose and the operators that you choose. And I like to tell a story. We're in our new house. My wife's an architect,
Hmm.
and we've done a lot of real estate in the Asheville market. My wife knows all the best builders in town. So we looked at the top 10 best builders, and then we narrowed it down to three that we interviewed. And we said, okay,
Ah,
we're going to work with this builder. And people say, well, why did you choose him? Why did you choose his group? And it wasn't because he builds the best house. Obviously, he's one of the top 10 builders in Asheville. Well, I wanted to work with the builder that I knew when something went wrong, because inevitably something's going to go wrong. I want to know, do they have the temperament and do they have the ability and the vision when something goes wrong? And same thing, a surgeon would ask me, hey, this is a great product, but what happens if it doesn't work well? How do I take it out? What's the worst case scenario? And I think that's very important. So thinking forward to the worst case scenario and making sure that you're comfortable being in bed with that person or that group if something's not going well, and confident that they are going to help get through that storm that's inevitably going to come.
last question. So the biggest misconception about the capital allocator industry.
It's easy, It's like people think, oh, I can just tell my friends about this, and I'm gonna get paid a bunch of money, and that is the wrong way to look at things, in my opinion. I think if somebody says, oh, just set up a fund, raise $1 million, it's not a big deal. You need to consider that there's a lot more pieces to that. And I think a lot of people forget about the personal aspect of the investors that are involved.
Chris Larsen, Next Level Income. Enormous pleasure to see you again. Thanks for joining me today.
My pleasure, Adam. Thanks so much.
All right, that was Chris Larsen, Next Level Income. Chris, what a pleasure seeing you again. Thanks so much. It's the second time we've had a lengthy conversation. You've interviewed me and I've interviewed you. And well, I look forward to spending some more time with you and to getting to know you a bit more, maybe even to transacting in some way in the future. But either way, thanks for joining me today. It was a total pleasure. And thank you, dear viewers, also for joining us today. I hope you found the conversation with Chris as interesting as I did. If you've not already subscribed to my newsletter, of course, go to garcrowd.com, find the subscribe button, and sign up. Comes out every week, covers everything you need to know about real estate, investment, and finance. And it's actually a lot of fun to put together. So hopefully that comes through as well when you read my newsletter. All right, that's it for this week. Thanks again for joining me. Until next time, it's Adam Gower signing off.